In 2025, I've been generating steady, consistent income every single month, not by trading stocks, not by chasing risky play, but by selling options using something called the whale strategy. In this video, I'm going to walk you through step by step through how the whale strategy works, how I personally run it in my portfolio, and how you can start applying it today. And no, you don't need to predict the market. In fact, you can get paid if the stock stay flat or moves slightly down. Let's break it down simply. The whale strategy is a systematic way to generate income from stock using option. You sell cash secure put to potentially buy stock at a discount. And if you are assigned, you sell covered call to collect even more premium while holding the stock. That is why it's called the whale. You keep cycling through these trades. Now let me show you exactly what I did last week using this whale strategy. This is how I trade option weekly. Every Monday, I sit down and take a look at the stock market. For me, Monday is a decision day because most of my option trades are constructed to start on Monday and expire on Friday, a full weekly cycle. For example, on Monday, on the 2nd of June, I review my watch list and make my trades for the week. Let's focus on these two stocks that I sell puts on that week. Nvidia and Amazon. Now, I only trade options on stock I personally like and that I believe are strong companies fundamentally. This is very important. Before you even think about selling options, you need to know which stock you are willing to own. The stocks you select will directly affect your success in option trading, especially with the whale strategy. So step 1, do your own research. Before selling any put options, I always do my own personal research to estimate the intrinsic value of the stock. I analyze the company fundamentals, earning, growth potential, balance sheet, and overall market condition. This step is critical because remember, when you sell a cash secure put, you are making a commitment. You are saying that if the stock drop below my chosen price, I'm ready and happy to buy it at that price. So having conviction in the company helps me stay confident even if the stock dips and I get a sign. That is why the whale strategy works best when you only trade on companies you genuinely want to own long term. Step 2. Selling cash secure put. Now that I've done my research and selected the stocks I want to trade, I move on to step 2. Selling cash secure put. On Monday, 2nd of June, I looked at both Nvidia and Amazon prices that morning. For Nvidia, the stock was trading around 135. I asked myself, what price am I happy to own Nvidia if the stock pull back? After reviewing my intrinsic value and my risk tolerance, I decided that buying Nvidia at 133 will be a comfortable entry price for me. So I sold a 133 strike put option expiring that Friday. For this trade, I received around 630 in premium upfront for this trade. That means if Nvidia stay above 133 by Friday, I keep the full premium of 630 as profit. If Nvidia drops below 133, I'll be assigned 100 shares at 133, which I'm fully prepared to own. However, something happened on Tuesday. Nvidia stock suddenly rise quickly. Because of this, the value of my put option dropped significantly. At that point, my option was already showing around 80% profit. Rather than waiting until Friday, I decided to close the trade early to lock in my profit and reduce my risk. So I bought back the put options for 104, which means I secure a profit of 522 for this option trade. For this particular trade, I opened 5 contracts, meaning I was responsible for potentially buying 500 shares of Nvidia at 133 if assigned. This required me to prepare a collateral of 66,500 for this single trade. This is extremely important for anyone trading option. You must always ensure that you have enough cash collateral to cover the position in case you get assigned. This is why I always trade cash secure put. Trading naked put without proper collateral can be very dangerous. If the market suddenly corrects and you don't have enough funds, your broker may issue a margin call and force liquidation on your stocks at any price, potentially causing massive losses. I used the same process for Amazon. That Monday, Amazon was trading around 205. I sold a 200 strike put option, collecting around 570 in premium for the week. Again, the key is always selecting strike price where I'm comfortable owning the stock, if assigned. That mindset gives me a peace of mind through the week, regardless of what happened in the market. By the way, if you are getting value from this so far, do me a quick favor, hit that subscribe button. I break down strategy like the real strategy, covered call, and real portfolio updates every single week. Alright, now get back to it. Step 3. Selling the covered call. Now let's move on to step 3. Selling covered call. This step only happens if my cash secured put get assigned, meaning the stock price dropped below my strike price and I now own the shares. Based on my portfolio spreadsheet, I recently got assigned on Nvidia and now owning 600 shares at 143. Instead of just holding these shares and wait for the price to go up, I put my shares to work by selling covered call to generate additional income. Once again, I ask myself, at what price am I willing to sell Nvidia for a profit while collecting premium? In this case, I chose to sell a 143 strike price call option expiring that Friday, and I collected around 348 in premium for 6 contracts. Now here are two possible outcomes. If Nvidia stay below 143 by Friday, I keep all my 600 shares and collect the full premium of 348 for 6 contracts. If Nvidia rises above 143, my shares will be caught away at 143, which still gives me a profit on the shares plus option premium. Since I'm selling 6 contracts because I own 600 shares, I collect a total of 348 in premium for the week. This is how I continue generating consistent weekly income while maintaining a clear plan. Whether the stock move up, stay flat, or even drop slightly. A very important tip, always make sure that the strike price of your covered call is above your cost basis, the price you bought the share at. If you sell a covered call below your cost basis, the stock get caught away, you may end up locking in a loss. Also, if you feel that weekly premium are too small, you can always choose to sell monthly covered call instead. Monthly option usually offer higher premium because you are committing to hold the trade for a longer period. But keep in mind, if the stock drops sharply while you are holding the shares, you still carry stock risk. In that case, depending on your risk tolerance, you might have to cut losses if necessary. This is why the wheel strategy works like a true wheel. The process keeps spinning. Whether I get assigned or not, I always have a plan to generate income week after week while managing my risk carefully. Now let me show you another real example for my portfolio, this time with Google. Based on my spreadsheet, I recently got assigned on Google and now owning 1000 shares at 180. But here's the thing, Google implied volatility is very low right now, which means the weekly premium I can collect from covered call are not very attractive. In situation like this, I adjust my strategy. Instead of selling weekly covered call with very little premium, I decided to sell covered call with a longer expiration date to collect more premium upfront. In this case, I sold a covered call that expired on 3rd of July 2025, about 1 month away. I'm selling covered call at the money, which means my strike price is the same as my cost basis, 180. This way, even if Google price suddenly jump up, I'm not worried about being assigned. My shares will be sold at 180, which is exactly where I bought them. So I won't incur any losses on the shares myself. For this trade, I sold 10 contracts and collect a total premium of 1,860 upfront. Because this is a longer dated trade and my risk is fully covered, I don't need to monitor this position closely every day. I simply let the trade run until expiration and it becomes a win-win situation for me. If Google stay below 180, I keep the full premium and continue holding my 1000 shares. If Google rises above 180, my shares will be caught away at break even, and I still keep the full 1860 premium as pure profit. This is another great example of how flexible the wheel strategy can be. Depending on the market condition, volatility, and stock behavior, you can always adjust your option selling to maximize the income while managing your risk properly. For those ready to jump into trading, I personally use Tiger Broker because it's great for option trading with great customer service. You can find my referral link in the description. If you sign up through it, you will usually get some cool bonuses and it helps support the channel too. Step 4. Summary and key risks and final tips. Alright, let's wrap everything up. This is exactly how I'm trading the wheel strategy right now in 2025. Week after week, I follow the same system. Number 1. Do my research and select strong companies that I'm willing to own long term. Number 2. Sell cash secure put on Monday at strike prices where I'm happy to buy the shares. Number 3. Manage the trade during the week. If I hit high profit early, sometimes I close the position and lock in gains. Number 4. If assigned, I move on to selling covered call on my shares to generate even more income. Number 5. I continue and repeat this process week after week. The biggest advantage of the wheel strategy is you generate consistent income, you stay invested in quality companies, you have a plan whether the stock moves up or down or sideways, but it is not risk-free. Here is some important risks to always remember. If the stock drops a lot, you will still have to hold unrealized losses on your shares. This is why stock selection is extremely important. Never trade naked puts. Always make sure you have enough cash collateral to cover your contracts. Don't chase premium on risky stock with poor fundamentals. Stick to companies you believe in long term. Sometimes you may have to sell covered call for many weeks or even months while waiting for the stocks to recover. Option trading is not a get-rich-quick scheme. It is a long-term strategy that requires discipline, risk management, and patience. Personally, I like to stay very transparent with my trade. That is why I record everything inside my Excel sheet, so I can track my exact assignment, premium collected, and my total income over time. Here's the final tip. The wheel strategy works best when you are treating it like you are running a business. Focus on steady income. Protect your capital and don't get emotional when trades doesn't go your way. You are not here to gamble. You are here to build wealth over time. If you find this video helpful, please give it a like, subscribe to my channel and turn on the notification. I share my weekly trades like live example and more tutorial like this to help you learn real-world option trading. Leave me a comment below if you want me to show you my full Excel tracker or break down more of my trades in the upcoming video. Thanks for watching and I will see you in the next video. Until next time, trade smart and stay profitable.